welcome to the Deep Dive. Today we're tackling portfolio management in India. Think of it as expertly choosing and handling a mix of investments, stocks, bonds, you name it, to really dial down the risk while, hopefully, cranking up the potential returns.
Right. And the person steering the ship is the portfolio manager. They're the ones crafting those custom investment blueprints for you.
Exactly. And for this deep dive, we've got this chapter excerpt that really lays out the world of portfolio managers, specifically in India.
Yeah, it's quite detailed. Our mission really is to navigate this with you, giving you a clear, insightful understanding of these portfolio management services, or PMS, in India.
We're aiming for the essential knowledge, without the overwhelm.
Exactly. Cut through the noise.
Okay, so to get us started then, in India, what is a portfolio manager, technically speaking?
Well, legally, the source material defines a portfolio manager in India as a body corporate, basically a registered company.
Okay, not just an individual then.
Right. And through a contract with you, the client, they can advise on or direct or actually undertake the management of your securities or your funds. And crucially, these PMS providers have to be registered with and regulated by SEBI, that's the Securities and Exchange Board of India. They operate under the SEBI Portfolio Managers Regulations from 2020.
So SEBI's the watchdog here, making sure everything's above board.
Absolutely. Think of it as SEBI ensuring, a level playing field and protection for investors like you.
So not just anyone can hang up a shingle and manage your money. There's a serious regulatory layer.
Definitely. And what's quite interesting, the chapter notes these rules were set up really early on, way back in January 1993.
Wow, 93.
Yeah. It's come into place, which kind of highlights how important the regulators saw this sector, even back then.
That is surprising history. So fast forward to today. Who are the main players offering these PMS services in India? What kinds of companies are we talking about?
The chapter points to mainly three types. You've got the big brokerage firms, the ones most people probably know.
Right.
Then there are the asset management companies, AMCs, that often run mutual funds too, but have separate PMS divisions.
Okay.
And finally, you have independent, often more specialized firms, sometimes called boutique PMS houses.
Boutique, okay. So they might have different strengths, I imagine.
Yeah, potentially. A brokerage might lean on its research arm. Maybe a boutique firm has a very specific niche investment style they focus on.
Like it gives us a good picture of the landscape. Now let's zoom in a bit on what these portfolio managers actually do. You mentioned different ways they can manage things.
You're right. We can slice it a few ways, like we just said, by who's offering it, AMC, brokerage, boutique. Another way is by what they're investing in. Is it mostly equities, fixed income, maybe commodities, or even other mutual funds? Or perhaps a mix of everything that's multi-asset PMS.
Right, different investment focuses.
And importantly, they also classify based on the client's net worth and the specific type of service they need.
Okay, so it's tailored on several levels. When it comes to the actual service provided, the chapter mentions three main types. Let's start with discretionary services. What's the core idea there?
With discretionary services, you're essentially giving the portfolio manager the authority, the discretion to make investment decisions for you.
Okay, so I hand over the keys, basically.
Pretty much. Based on your agreement, they can buy and sell securities without needing your explicit okay for every single transaction. They might follow a preset strategy or create a totally custom one based on your goals and risk appetite.
So using that analogy from the source, it's like hiring a chef who chooses the menu based on your tastes and what's fresh in the market.
That's a perfect analogy, yeah. They're in charge of the day-to-day investment decisions trying to get you to your financial destination.
Makes sense. Now, the next one, non-discretionary services. Sounds like the opposite.
It really is, yeah.
Yeah.
A totally different ballgame. With non-discretionary, the portfolio manager acts more like, well, your order taker and execution arm.
Order taker?
Yeah. They only buy or sell securities when you specifically tell them what to buy or sell and when. You, the investor, keep all the decision-making power.
Oh, okay.
Their main job is just to carry out those trades efficiently for you.
So, sticking with the food analogy, if discretionary is the chef choosing the menu, non-discretionary is like me telling the chef exactly what dish to cook, maybe even giving them the recipe.
Precisely. You're calling all the shots,
Yeah.
What to buy, what to sell, at what price. They just handle the mechanics.
Got it. And the third type is advisory services. How does that fit into the mix?
Advisory is lighter touch, you could say. The portfolio manager provides you with investment advice, analysis recommendations. That's it.
Just advice.
Just advice. They don't have the authority to make decisions for you or execute any trades. You get their expert opinion, their suggestions, and then it's entirely up to you whether you act on it and you handle the buying and selling yourself or through your own broker.
I see. So they might suggest selling stock X and buying bond Y, but I have to actually place those orders.
Exactly. The chapter mentions this is often used by larger institutional clients who have their own teams but want external guidance.
Okay, so it's like getting directions from a financial GPS, but you're still the one driving and deciding whether to follow the route.
That's a great way to put it. You get the benefit of their expertise, but the final decision and the action are yours.
Okay, that really clarifies the different service types. Now let's circle back to the structure. We mentioned body corporate. Is there more to understand about how these PMS entities are actually set up?
Well, the main point about it being a body corporate is that it's a formal legal entity. It has its own legal existence separate from the individuals running it.
Right.
And that's important for regulation, for accountability. If something goes wrong, there's a clear legal entity that's responsible to you, the investor.
Right, it's not just some person operating informally. Now, to actually be a portfolio manager, they need that SEBI registration. What does that process involve? Sounds like it might be rigorous.
Oh, it is. And it should be, right? They're handling significant amounts of client money. The first step is submitting a really detailed application to SEBI. It's called Form A, and it comes with a non-refundable fee.
Form A. What kind of details are they asking for in this form? What are they digging into?
Pretty much everything you can think of about the company. Basic stuff like name, PAN, address, sure. But also their entire organizational structure, who reports to whom. Details about their infrastructure, office space, IT systems, manpower. They need a comprehensive business plan looking out 3 years.
3 years, okay.
And a deep dive into their financials, capital structure, their net worth, sources of income. SEBI also wants to know about any disputes they're involved in, exchange memberships, things like that.
Ah, that's extensive.
It doesn't stop there. They need details on their business processes, how they make investment decisions, how they profile client risk, handle grievances, their research capabilities. Yeah. They also need to show their experience in financial services, provide draft client agreements, a draft disclosure document, details of their custodian, any other registrations they might hold.
It really sounds like SEBI wants a complete picture before handing out a license.
Exactly. And finally, there's a declaration section where they have to confirm they'll comply with all the rules, they meet the fit and proper criteria, they'll do the required reporting and record keeping. It's thorough vetting.
No kidding.
Yeah.
So once they submit all of that, what are the specific criteria SEBI uses to say yes or no?
SEBI has a clear checklist they go through. First, as we said, the applicant must be a body corporate.
Check.
They need to demonstrate they have all the necessary infrastructure, the office, the tech, the people to actually run the business properly. A really important one is the appointment of a dedicated compliance officer, someone whose job it is to make sure all the SEBI rules are being followed constantly.
Right, a rule keeper inside the firm. What about the people actually managing the money? Any specific requirements for them?
Oh, absolutely. SEBI lays out clear rules for the principal officer. That's a key management person in the PMS firm.
Principal officer.
They need a professional qualification, usually in finance, law, accountancy, or business management. Plus, crucially, at least 5 years of relevant experience.
5 years in what exactly?
Experience working as a portfolio manager or a stockbroker, fund manager, maybe an investment advisor. Basically, hands-on experience in the securities market. And they also need to pass a specific certification from NISM, the National Institute of Securities Markets.
So formal education and real-world experience and a certification. That's quite a hurdle.
It is. And beyond the principal officer, the firm needs at least one other employee who has a relevant graduation degree and at least 2 years of experience in the securities market.
Okay, so minimum staffing levels with qualified people.
Yeah.
What else is on SEBI's checklist?
They look into the background very carefully. Any past disciplinary actions taken by SEBI or other regulators against the applicant or people associated with them, that's a red flag.
Naturally.
There's also a minimum net worth requirement. Currently, it's 5 crore rupees. This is to ensure the firm has some financial stability, some skin in the game.
5 crore.
Okay.
Yeah, a significant amount.
Yep. They also check for any history of litigation related to the securities market involving the applicant or its key people, and any convictions for moral turpitude or economic offenses are obviously a big problem.
Right, looking for ethical red flags, too.
Fundamentally, SEBI has to be satisfied that the applicant meets the fit and proper person criteria. It's a bit subjective, but it covers integrity, reputation, financial soundness.
Fit and proper.
And ultimately, the overriding consideration for SEBI is whether granting the certificate is actually in the best interest of investors like you.
That seems like a really robust system, designed to filter out unsuitable players and protect investors. Once they get this registration, how long is it valid for?
Well, the registration itself is basically valid unless SEBI decides to suspend it or cancel it.
Ah, so it's not like a driving license you renew every few years.
No, it's ongoing, but SEBI keeps monitoring. If the firm breaches regulations, SEBI can step in and take action, including pulling the registration. So there's continuous oversight.
Okay, good to know it's not a one-and-done approval. So, once a firm is registered and managing client money, what are their main responsibilities according to SEBI? What do they have to do?
The regulations spell out quite a few key duties for those discretionary managers we talked about.
The ones making the decisions.
Yes. A core responsibility is managing each client's funds and securities individually based on that client's specific needs and the agreement. This is a major difference from, say, a mutual fund where everyone's money is pooled together.
Right, it's personalized.
Very much so. Also, there's that minimum investment threshold we touched on. Portfolio managers in India cannot accept less than 50 lakh rupees from a single client.
50 lakhs. That's definitely a significant entry barrier for many people.
It is. It means PMS is generally aimed at high net worth individuals, or HNIs, who are looking for that bespoke management.
Okay. What other responsibilities do they carry?
A huge one is their fiduciary duty. This is a legal obligation to act in the best interests of the client, put your interests first, above their own, manage your money with utmost good faith, care, and integrity.
Fiduciary duty. That sounds critical.
It is. It underlies the whole relationship. Practically, they also have to ensure each client's securities are held in separate accounts, no commingling.
Segregated accounts, okay.
And client funds, the actual cash, must be kept in a separate account with a scheduled commercial bank, again, keeping your money safe and distinct.
Good safeguards. What about potential conflicts of interest, like investing in their own related companies?
SEBI addresses that directly. There are limits. A portfolio manager can't invest more than 30% of your portfolio in securities of their own associates or related parties.
30% max.
And even then, only with your specific one-time written consent beforehand, so you have to explicitly agree to it.
That seems like a reasonable control. Are there restrictions on the types of investments they can make?
Yes, a couple of key ones mentioned. They are prohibited from investing client funds in securities that are rated below investment grade.
So no really junky, high-risk bonds.
Generally, no. They also have to respect any specific limitations you might place on dealing in certain securities, perhaps under RBI rules. And a fundamental rule: they absolutely cannot derive any direct or indirect benefit from your funds or securities other than their agreed-upon fees and charges.
No hidden kickbacks or anything.
Exactly. Also, they're prohibited from borrowing funds or securities on behalf of the client.
Can't take out loans using my portfolio.
Correct. And there are restrictions on lending out your securities to third parties as well.
Okay, lots of guardrails there to protect the client's assets. What if I, as a client, have an issue or a complaint?
The portfolio manager has a specific responsibility to handle client complaints properly and, importantly, promptly. They need to take immediate steps to address the grievance.
So a responsive complaints process is mandatory.
Yes. And their responsibility extends outwards, too. They have to ensure that any entities they use for distributing their services, like agents or brokers, also comply with all the SEBI regulations.
So they're responsible for their distribution chain, too.
That's right.
True. All these responsibilities really highlight the level of trust involved here. Now let's shift to something investors are always interested in: costs. How do portfolio managers typically get paid? What are the fees like?
Good question.
Yeah.
Generally, the source points to two main types of costs you'll encounter: fixed costs and performance-linked costs.
Okay, fixed first.
Fixed costs are usually charged as a percentage of the total assets they're managing for you, your assets under management, or AUM. You pay this fee regardless of how well or poorly your portfolio performs.
Like a management fee on a mutual fund.
Similar idea, yes. And this fixed fee often includes or is alongside other costs like brokerage fees for the trades and other transaction charges. It's the baseline cost of the service.
So you pay this percentage even if your portfolio value goes down in a particular year?
Typically, yes. It covers their ongoing management effort. Then you have the performance-linked costs.
Okay, this sounds like it's tied to results.
Exactly. These are often called profit-sharing fees or performance fees. It's an additional fee designed to incentivize the manager to generate better returns for you.
Aligning their interests with mine.
That's the goal. These fees are based on hitting certain pre-agreed performance targets, which should be clearly spelled out in your PMS agreement. If they exceed those targets, they get a share of the profits generated.
But the source warns these can be substantial.
They can be, yes. If your portfolio has a really great run, the performance fee can add up significantly. It's something you really need to understand up front.
Definitely. Now, I've heard about something called the high watermark principle in relation to these performance fees. What's that all about? Why should I care?
Ah, the high watermark.
Yeah.
This is a really important protection for you, the investor. It's designed to be fair.
How so?
It basically ensures that the portfolio manager doesn't get paid performance fees repeatedly on the same gains, especially after a period of poor performance.
Okay, explain that a bit more.
Imagine your portfolio reaches a peak value of, say, 100, and you pay a performance fee based on that. Then the market drops, and your value goes down to 90.
Right.
The high watermark principle means the manager can't charge any performance fee until your portfolio value climbs back up above that previous peak of 100.
Ah, I see. So they only get paid on new gains above the highest point they've reached before where a fee was charged.
Exactly. They have to earn back any losses first before they can start sharing in profits again. It prevents them from charging you fees just for recovering lost ground.
That sounds very fair. A good alignment of interest.
It really is. Returns are typically calculated annually for this, and the profit sharing only kicks in if the return is above a certain hurdle rate and the current value is above that previous high watermark.
Okay, you mentioned a hurdle rate. What exactly is that?
The hurdle rate is simply the minimum rate of return your portfolio needs to achieve before any performance-linked fees start getting calculated.
Like a minimum threshold.
Precisely. It's specified in your PMS agreement. For example, if the hurdle rate is, say, 8%, your portfolio has to grow by more than 8% in that period before the manager is eligible for any performance fee.
Okay, so they have to clear that hurdle first. Then the source mentions this idea of catch-up or no catch-up relating to these fees. What's the difference there? That sounds important.
It is quite important as it affects how much fee you actually pay. It's about how the performance fee is calculated once that hurdle rate is cleared.
Okay.
With a no catch-up structure, the performance fee percentage is only applied to the returns above the hurdle rate.
Only on the excess return.
Right. So if the hurdle is 8% and the portfolio actually returns 10%, and let's say the performance fee is 20%, with no catch-up, that 20% fee is calculated only on the 2% difference, 10% minus 8%.
Got it. What about catch-up?
With catch-up, once that 8% hurdle is crossed, the performance fee, that 20% in our example, is calculated on the entire return above zero, or potentially above a different base. So in our 10% return example, the 20% fee might apply to the full 10%, not just the 2% above the hurdle. It effectively lets the manager catch up on the returns below the hurdle once the hurdle is met.
Wow, okay, so the catch-up method could result in significantly higher fees for me if the portfolio does well above the hurdle.
Absolutely. It's a really crucial detail to check in the agreement's fee schedule. Understand whether it's catch-up or no catch-up.
Definitely something to watch out for. Now, let's switch gears slightly and talk about this direct access facility in PMS. The outline mentioned it sounds like a way to potentially save on costs.
That's exactly the idea. It draws a parallel with direct plans and mutual funds, which many people might be familiar with now.
Right, where you bypass the distributor.
Precisely. The direct access facility in PMS lets you invest directly with the portfolio manager, cutting out any intermediaries like brokers or distributors who might have brought you to the PMS provider.
And the benefit is lower cost.
Yes. By going direct, you avoid paying commissions to those intermediaries. Those commission costs are usually embedded in the fees of the regular plan. So the direct plan typically has a lower expense ratio or fee structure.
Which means potentially higher net returns for me, the investor.
That's the potential outcome, yes. All else being equal, lower costs should lead to better net returns over time.
Does choosing direct access change anything about how my portfolio is actually managed? Does the manager treat it differently?
No, not at all. The underlying investment management, the strategy, the decisions, the portfolio construction, it all stays exactly the same. Whether you invest through a distributor plan or the direct access plan, you're getting the same fund management service.
The only difference is the cost structure.
Exactly. Just the fees.
It seems like a really smart option for investors who feel comfortable doing their own research and choosing a PMS provider without needing a distributor's help.
It can be, yes. For investors who are knowledgeable and don't require that hand-holding from an intermediary, going direct can save them money.
What role do investment advisors play in this? Do they talk about direct access?
They absolutely should. A good investment advisor has a responsibility, really, to educate their clients about this option. They should explain that direct access exists in PMS and highlight the potential cost savings.
Especially for clients who might not need the distributor service.
Right. But the advisor's role is broader too, of course. They should be helping you figure out if PMS is even suitable for you in the first place compared to, say, mutual funds or direct equity.
True. Assessing suitability first.
And if PMS is suitable, helping you decide which type of service, discretionary, non-discretionary, or advisory, makes the most sense for your situation and comfort level. And then, yes, discussing the direct versus regular plan options.
So the advisor acts as a guide through that whole decision process, ideally helping you find the most cost-effective and suitable path.
That's the ideal, yes.
Okay, finally, let's touch upon SEBI's requirements regarding performance disclosure. Transparency is obviously crucial when you're trusting someone with a large sum of money.
Absolutely critical. And SEBI has put rules in place for this. First off, there must be a written agreement between you and the portfolio manager before they start managing anything.
A formal contract.
Yes, and this agreement has to clearly lay out all the important terms and conditions as specified by SEBI vet regulations.
Well,
on top of the agreement, the portfolio manager is required to provide you with a disclosure document. This document has to contain a whole set of specified information.
a disclosure document. What kind of information has to be in there? What am I looking for?
Key things include the exact quantum and manner of payment for all fees associated with each type of service they offer. So total clarity on costs.
No hidden charges.
Hopefully not, it should all be there. It also needs to detail the portfolio risks associated with the specific investment approaches or strategies they use.
So they have to be upfront about the potential downsides, too.
Yes. And it needs to include disclosures about any related parties like those associate companies we mentioned, as per standard accounting rules. This document isn't just for you either. It has to be available on the portfolio manager's website for anyone to see, and it also gets filed with SEBI.
Okay, so it's public information promoting transparency. What about how they report their actual investment performance? Are there standards for that?
Yes, SEBI mandates uniformity here. Portfolio managers have to report their performance figures using a consistent methodology across all their communications.
Consistent where?
Whether it's in the reports they submit to SEBI, in their marketing brochures or presentations, in the periodic reports they send directly to you as a client, or what they publish on their website, the performance calculation method must be uniform.
That makes it much easier to compare apples to apples when looking at different PMS providers, right?
That's exactly the point. It allows for meaningful comparison. They also have to clearly disclose the range of fees charged under various heads within that disclosure document, so you can see the potential spread of costs.
That level of mandated transparency really seems designed to empower investors, letting them see clearly what they're getting into and what they're paying.
Precisely. It's all about informed decision-making.
Well, this has been incredibly insightful. We've really covered a lot of ground on portfolio management services in India today.
We have.
We've looked at, the basic definition, the different flavors of service, non-discretionary advisory. We've dug into the strong regulatory framework under SEBI, the detailed registration process.
Right, the responsibilities, the fiduciary duty.
The different ways they charge fees, including those important concepts like high watermark and hurdle rates.
And the catch-up nuances.
Plus, the direct access option for potentially lower costs. And finally, these crucial rules around transparency and performance disclosure. It's clear that PMS in India is quite a sophisticated offering, really geared towards investors seeking that highly personalized investment management.
Exactly right. Our goal today was really to provide that solid foundation to give you the key aspects of PMS in India and hopefully demystify some of the jargon and complexities involved.
And I think we've done that. So, just to leave you, our listener, with something to mull over, considering all these different facets we discussed, the service types, the fee structures like fixed versus performance-linked, catch-up versus no catch-up, How would you personally evaluate whether a PMS offering truly aligns with your own unique financial situation, your long-term goals, and perhaps most importantly, your individual comfort level with investment risk? Maybe digging into those SEBI regulations directly could be a useful next step if you want an even deeper understanding. Thanks for tuning in to The Deep Dive.